Good morning, everyone, or good afternoon, depending on where you're joining us from. I see we've got people filtering in through. So, welcome back to another session of Market Mondays, the webinar that Kyle and myself host every Monday morning or Monday afternoon if you're in Australia to take you through what's been happening in markets over the weekend, and of course, a look ahead at to what to expect this week going forward. So welcome back, everyone. Let's quickly just get through some compliance comments as always. I'm sure most of you are aware, but just keep in mind that spread bets, for those of you in the UK, and CFDs are complex financial instruments, and they do carry a high level of risk and risk of losing your money. So when trading with these instruments, just be aware that you understand them and that you know the risk involved. And also keep in mind that this webinar, the information we are sharing with you today, is just our opinion. It's just for information purposes. It's not meant to be taken as us telling you what to do. It's not meant to be taken as a guide for what to do in your trade. It's just for you to be aware of what's been going on and just our opinion on the markets. Kyle, good morning. Do you have anything else to add?
No, not at all. Not personal advice and things. These products are risky, so make sure you consider your own circumstances if before you trade these things. But I thought quickly I'll just run through just some of the key themes and events, shall we, Danny? Then we'll go
Yep.
look at the charts and begin our conversation. But obviously, the big news is the trade developments over the weekend, and of course, we had a trade deal between the US and UK last week. But all eyes are on Switzerland, and we'll run through that a little bit today. I thought we might kick off in a second with the FOMC, Danny, because we can get that out of the way, and then we can dive into the trade stuff because that's a little bit more contemporaneous. But we've also got a bit of data out this week in terms of US data and UK data. So we'll touch on that as well, maybe even discuss some of the Australian labour market data that comes out and that might greenlight the RBA's next move. But clearly, trade's the big one first and foremost. We'll do live Q&A at the end. Maybe, again, we'll start with the FOMC because that's kind of done and dusted and history. But I think what can be said in the context of everything else is that the message that we got from Powell, Danny, was that it's wait and see. Risks have increased to both sides of the Fed's mandate. And I don't know if there was a Fed decision in which Jay Powell tried as hard as he did to say as little as he did than the one that we got last week. Did you have any other impressions? Because it would sort of seem that the markets were initially like a little bit disappointed because there wasn't that kind of indication that they'd keep cutting rates despite this expected price shock from tariffs. But at the same time, they didn't really rule it out. They just said we're just going to have to wait things out. We think we have a bit of time.
Yeah, as you say, I think that was the key goal from Powell going into this meeting. He just wanted to disrupt markets as little as possible, just give as little as possible away. I mean, it's no surprise, really. No one really knows, not the central bank, not the general population, what's going to happen after the July 18th, which is when that extension in the tariffs ends. So, it's reasonable for him to be reluctant to make forward commitments that could box him into a corner, to give any forward guidance when he doesn't really know what's going to happen with trade relationships with other countries and the US. Of course, everything is pointing upwards now, and we know that sentiment has changed, and it looks like a deal is almost confirmed with the UK, and it seems like the US is really close to negotiating with many, many countries that were on that high tariff list. But until that is confirmed, it's still an uncertainty. And with the central bank, as it is, the US economy remains strong. Yes, we've seen inflation soften. Yes, we've seen the labor market soften. And that growth data that came out for the first quarter did shock investors a little bit. But then the central bank came out and justified that, it was skewed by net export data. And of course, companies bringing in imports forward because of these expectations of tariffs. So all in all, the US economy is definitely not in a dire situation. We're not in a situation where the central bank needs to come out and rescue the economy and rescue growth. So why would Powell and his team make a decision right now when everything is so uncertain, when he can wait a little bit longer and see how everything evolves. And I think that's kind of the message that I got from there, is that it made no sense to make any irrational decisions just yet. The economy is withstanding pretty well. Yes, it's softening, but that's normal given the period we're in. And as you said, Powell just tried to be as little committed as possible, say the least possible. And markets were a little bit disappointed with that. But I think even though he did, in a way, kind of, even though he remained non-committed, he did wanted to point out, I think, to markets that, the risk of inflation still remains high if these tariffs go forward, because it kind of feels like markets have kind of gotten to that point where they think, okay, inflation's or the risk of hyperinflation once again is out of the window, where, everything's moving forward and, this inflation continues. But I think he just wanted to highlight that even though he's not really committed to cutting rates just yet or moving rates in any way, he wanted to highlight that the risk of unemployment and the risk of inflation still remain in the upside if these tariffs go ahead. But even then, markets kind of brushed that to the side and said, well, no, everything's looking, forward and everything's looking up with tariffs. So we can forget about that for now. And that's kind of the feeling that I got, Carl, and the way the markets reacted. It's, let's just remain positive. Let's stay on the optimism side of things. Trump the US and China seem to be getting closer and closer. Of course, this was last week before the weekend. And markets were just like, let's focus on that. Let's focus on the positive. And Trump, Powell's warning, let's kind of move that to the side for a little bit.
That was interesting, I think, what you said about the Powell's assessment of the data, and that more or less there was the interpretation that overall things were okay for now. If there's one fatal conceit that may be revealed in time, and we simply don't know, and this is the big question for markets, is whether things are as strong as they are appearing to be, at least on the surface of some of the jobs data that we got last week, the inflation data that we got last week, both of which were, good. Jobs are still being added to the US economy. The last NFP showed us that. The PCE data was modest, trending lower still. The GDP data, as you said, wasn't great, but is being distorted a little bit by net exports. Powell's whole message is that we have time on our sides. A lot of the journalist questions, the reporter questions at the press conference was the effect of, well, there's all these indications that we might be heading for something of a supply shock, a fairly significant slowdown. Powell's whole message was that, no, we think that things are okay and we can kind of just wait for the incoming data. It's an interesting one because it becomes a question of sort of tipping points. At what point in time do tariffs actually start to have a material hit on the economy and cause these sort of upside risks to both unemployment and inflation to actually manifest in the data? What remains, it would appear to be, what it appears to be the case, as you were noting before, Danny, is that the markets are taking the glass half full perspective on this. Although Powell didn't suggest that they would, or the Fed would cut interest rates still if we did simultaneously get a spike in unemployment and inflation, the markets are still pricing in that that's what will happen, although slightly deferred. So the markets are still pricing in effectively 3 rate cuts, maybe even 4 rate cuts before the end of the year, which suggests that they're kind of banking on the Fed lowering rates to protect the labor market, even if inflation starts to pick up a little bit. So if we do run into a particular issue at some point in time, it will be if the economy isn't quite as strong, that the Fed didn't have as much wriggle room or time as Powell was kind of expressing last week, and it subsequently doesn't. Its reaction function isn't what the markets expect, which is to cut interest rates despite price shocks. That's when things could get a little bit hairy. But again, like you said, Danny, Powell played a small target that was effective, and the markets continue to price in that eventually the Fed will cut interest rates to protect the economy from a slowdown.
Just on that, before we move on quickly, I do want to say what's going to be quite interesting for me going forward is when we get the updated summary of economic projections. I think it will be next meeting. I think it's June next month. Because as you said, something that's interesting is whether Powell's comment should be taken just as cautious, and him not wanting, as I said, to back himself into a corner, wanting to keep the possibilities open. He didn't commit to any rate cuts, but he didn't really say anything otherwise, as you said. But could it be interpreted maybe as a potential hawkish warning, given that he did indicate that the risk of higher inflation, and it's something that we know that the Fed has been quite hyper fixated on, in the way that the ECB has allowed itself to cut rates, even though inflation wasn't showing that much significant progress in the process. The Fed has wanted to wait and see the data drop before it actually acted. So, that tone, was it simply cautious, or was there maybe a little bit of hawkishness in there? And as I said, what's going to be interesting is that updated economic projections, because as you say, markets continue to price in 3 rate cuts for this year, but the last dot plot chart actually showed just 2 from the Fed, and that was before the April 2nd tariff. So again, it's going to be interesting when we get the updated projections, whether anything has changed, not only in terms of the general rate cuts expected, but how individual central bank members now see the rest of the year progress, given given what's been happening. Also, I do have to note that next economic projection will be before that July 8th tariff extension. That doesn't mean that from now until then we may see tariffs cancelled completely. I mean, the way things are going and the way the way trade deals seem to be emerging here and there, we could potentially be in a situation next month where the Fed is pretty content that tariffs are not going to go ahead, or at least not as aggressively as initially thought. But it'll be interesting to see how those economic projections change from the Federal Reserve, and whether they start to be a little bit more lenient towards rate cuts, or whether there's still going to be that discrepancy between markets and the Fed, and that could cause a little bit of volatility in markets.
Yeah, and one final point on that before we go on to trade, because we're already kind of veering towards that discussion, is that those last summary of economic projections, like you said, only said 2 cuts for the year, but still implied cuts this year, or at least the median dot still implied these cuts this year, despite lifting the inflation forecast, which I think is where the hope initially came into the picture, that, well, maybe the Fed will keep cutting rates through one-off price shocks, whereas some of the language from Powell in the last 2 or 3 weeks, especially after the Liberation Day tariffs, was to the effect of, well, we can't be so confident in cutting interest rates if there is a price shock, because we're scared of, basically turning what could be a one-off thing into ongoing inflation. So like you said, Danny, that statement, summary of economic projections in June, will be fascinating. And of course, we get lots of data between now and then, including, potential trade deals. But the reaction function, I think, I don't know, Danny, you might agree or might not. The reaction function isn't exactly clear yet, probably by design from the Fed, because it's not sure itself, but we don't know how the Fed will respond necessarily to these changing fundamentals.
Yeah, agree. And we don't know what headspace markets will be come that, because again, now we seem to be in this wave of optimism that's been driving markets higher, specifically equity markets. It's a little bit of a rebound in the dollars we'll see in charts, but who knows, in 3-4 weeks time, we could be in a headspace where everything seems a little bit more dire, and therefore markets a little bit more sensitive to the downside. So for now, it looks like everything's looking up, but who knows? Everything's been so quick.
Well, let's move on to the trade discussion then, because I feel that's the way I've been framing it to people in my own head as well, is that the data's strong, but it's backward looking. Clearly bad things are happening in the economy to some extent, because we're getting that in business surveys and consumer surveys, and we're seeing it in real-time data like port, what do you call it, port movements, or shipments between US and China, whatever it is, live shipment data and things of that nature. So clearly negative things are happening. But if you look at the data that the Fed tracks, yeah, GDP was poor, but it was slightly distorted. The labor market's holding up okay. It would seem that businesses are just sort of working through inventories, that layoffs haven't really materially occurred yet, or at least en masse. Investment is being deferred, not quite destroyed at this point in time. The markets are continuing to rally on the hope that more or less the worst of this will be avoided. The narrative clearly has shifted from the Trump administration. I don't think from the start there's been a very clear and coherent strategy when it comes to trade. The goalposts have moved frequently, and I think the goalposts are moved now in a way that the Trump administration are trying to achieve trade deals ostensibly to lower tariffs across the board, or at least extract more favorable trading conditions for the US. The UK-US trade deal was a good example because the UK came out probably on the wrong side of that on an aggregate. Obviously, automakers and things like that, will see a lower level of tariff, but on average, the tariff across the entire US economy, or UK imports, is going to be about 10%. That seems to be the goal of the Trump administration now. Damage will be incurred, but the markets just seem to be buying into just the good narrative, and at least, if nothing else, that the Trump administration isn't looking to completely break the global trading order. It's hopefully looking just to extract a better deal for itself, and ultimately that will be better than the worst case scenario that the markets were pricing in a few weeks ago. As a result, we've got equities tonight probably rallying. For example, on the S&P 500, we'll probably see that 200-day moving average cracked. The NASDAQ will probably crack the 200-day moving average as well. We're looking at a 2% move in the NASDAQ. For me, we'll wait for the substance around this statement, this joint statement that we're going to get between the US and China at some point today, covering what maybe have been achieved at these talks, perhaps some kind of negotiating framework, as I understand it, perhaps some reduction in tariffs, possibly the fentanyl tariffs, if there's kind of strong indications there that China's going to take measures to curb the flow, to whatever extent that is true or not, into the United States. Again, despite all this like headwinds, all the potentials that bad things are happening in the US economy right now, investors are looking at things at a glass half full perspective. For me, it's whether the narrative is matching reality, or if this is purely narrative and we're about to hit a big air pocket. I don't know how you're framing it in your mind, Danny, because for me, I'm generally nervous that maybe there's still nastiness to come from these tariffs, but certainly the market seems to be pricing in a pretty rosy outlook.
Yeah, I agree. I've got two general views on this. One is on what's actually happening now and what you're saying, that everything seems very positive. The feedback we're getting ahead of this statement seems positive. Both the US and China have both made individual statements where they seem to show significant progress towards something. Now, what that something is maybe, as you said, where that shock could come from. Now, I think something to highlight is that maybe sometimes there has been maybe some misrepresentation that the fact that these initial talks don't necessarily mean that a trade deal is going to be done, especially not in the short term. These just represent the beginning of a potential negotiation process, which is going to be very lengthy because there are, as you said, a lot of structural issues that need to be resolved between China and the US, which have been butting heads for a while, specifically with trade. Now, there are several scenarios that can come from this. This can be just a minimal de-escalation, and specifically this first meeting is just likely to be a symbolic concession or an agreement to continue discussion, to continue to try and resolve these issues in the near future. And then, markets have been very, very positive. Could we see potentially that bullishness continue, or where the markets may be a little bit disappointed that, and this feeling that, oh, that's it's just a formal agreement to continue working together. We could see, that going forward. We could see an actual framework agreed, or we could see, more significant progress made. But on the other side, we could actually see deterioration, which doesn't seem likely given the feedback we've had, but it's something to keep in mind going forward, that until the actual trade deal is reached, the way things have been moving and the way things have been changing in the last 6 weeks, we could see that even though everything seems to be getting better, deterioration can happen in the progress, and that's something that markets need to be aware of and prepared, to accept. And the other point to make is looking further ahead into the future, and let's say that the best case scenario happens, which is what markets are expecting or hoping, that the US and China make a very positive deal, and the US actually makes really good progress with deals in other countries, and that the whole tariff scare just stays at that, as it was a scare. Everything, kind of the status quo pre-April 2nd, is maintained, and trade in the global economy remains, how it was before. How do markets react then? So once all of that positivity has been priced in, how do markets then view the state of the US economy? Because a lot of the negative data has been attributed to those scares with the consumer data, the business confidence data. All of that has been attributed to, oh my God, tariffs are coming. We're scared what's going to happen to the US economy. The GDP data, again, attributed to it being skewed because of that net export data. Let's say this all goes out the window and everything goes back to how it was and everything's really good and positive. How does the US economy remain? How does the state of the US economy remain? And how do markets actually react to that once that kind of blindfold has been taken off the eyes? And I think I don't really know what the answer is, but I think that's going to be very interesting. Again, I'm not saying that's what's going to happen. That is just if the best case scenario happens. Does that positivity in markets have enough strength to continue significantly, or do markets then kind of go, oh my God, wait, and now what?
I agree. It's an interesting point you bring up as well as to what's actually priced in at the moment, because if you look from the top to bottom drawdown, once these trade fears really started to drive price action in US equities, there was about a 20% drawdown, 25% drawdown. That kind of move is significant, but certainly not reflective of an economy that could head towards a recession this year. As you noted before, we've already seen one kind of quarter of negative growth, but obviously that in and of itself, and even if we do get another quarter of negative growth, that in and of itself won't necessarily be enough to technically classify a US recession. But running like a counterfactual, if we get to a position where tariffs are dropped on China, they're dropped on other major trading partners through probably fairly cobbled together deals that are likely to be a bit half-baked, because normally these things take years to construct. So they'll probably be half-baked, but just let's assume that the tariffs get dropped in some capacity and things aren't as bad as they currently are. What level of tariffs are currently discounted into the market, and what subsequent slowdown in economic activity is therefore priced into the market as well? Because if tariffs, for example, last week, Trump said that an 80% weighted average level of tariffs across the Chinese economy might be appropriate. I assume he's highballing, but let's say if that's the number. Is an 80% tariff and the impacts on global growth discounted in the S&P 500, or can we say it would have been discounted in the S&P 500 with merely a 20% peak to trough drawdown? At 60%, has it been priced in? I'm not so sure that it necessarily has. So this is the thing for me, is that not only is it kind of unclear what we're going to get in terms of the impacts of the existing uncertainty, but we don't really know yet what the impacts are going to be of whatever level of tariffs that the Trump administration is going to push ahead with, assuming, and probably safely assuming, that we're going to see on an absolute level a higher level of tariff prevailing on every trading partner, every US trading partner. If we look at what happened with the US and UK deal, because the tariff is now 5 times the average tariff is now 3 or 4 times the average what it was before Liberation Day. If that is true across the board in terms of all of the US's trading partners, is that impact priced into markets yet? I'm not so sure, and that's why I'm constantly trying to grapple with this. Markets are buying into a positive narrative. They're probably pricing it a little bit too, that Trump's not going to break the financial system anymore with sort of pushing through these radical policies that really caused a few things to creak a few weeks ago. He's probably much more conscious of not destabilizing the US dollar and US Treasury markets, especially given their important function, not just for US economic power and strategic power, but also just the functioning of the global financial system. Okay, maybe we price out some of those things, but still there's the real world impact on company profits that has to be discounted. Is the existing drawdown that we've already seen in the S&P 500 fully reflective of that? I don't know. Maybe I'm just too cautious. Obviously, we need to see what the trade deals actually encompass. But if they don't arrive immediately, and the average level of tariff on China still happens to be on a trade-weighted basis, something 60%, maybe stripping out some of the exempt goods, semiconductors and things of that nature, which means that overall it'll probably be a little bit lower, especially to some fairly key industries in the United States. Again, it gives me the sense that this optimism is maybe on a little bit of shaky ground, that there might be a bit of a divergence again between narrative and reality. But maybe we can talk about the price action, Danny, because if you look at the
Yeah.
price action, my caution would be completely unjustified, because we're about to push through again the 200-day moving average, push through a fairly key level of resistance on the S&P 500 and the Nasdaq. The US dollar is picking up again, suggesting that US assets are back in play. Treasuries are stabilizing a little bit. We are looking at a market that, if you just strip out the noise and maybe the sentiment, price action actually looks positive.
Yeah, we continue to undo that negative impact of the tariff announcement, and kind of a little bit of that, shifting away from US exceptionalism, even though it still continues to some extent. I think we have undone a little bit of that extremeness in it. And that's, of course, just suggesting that markets are, again, positive about this. And I think this discussion we're having here actually kind of validates, Powell's and the Federal Reserve's wait and see stance, don't you think? I mean, if we're confused as to what's going to happen, imagine them, who are in charge of, one of the biggest economies in the world. So it just validates that, tariffs still have so much impact in terms of uncertainty into what's going to happen and how much the economy is prepared for it and how much markets are priced in, that it just kind of makes sense, to not commit to anything. Let's quickly take a look at what's coming up this week. And then if any of you guys joining us, if you have any questions, anything you want to ask us, then do feel free to put them in the question box or in the chat box, and then we'll get to that just after, just so we don't drag this along too much. We do have key US data this week and UK data. Quickly, from the UK side, we did have the Bank of England meeting last week. Everything went pretty much as expected. The Bank of England cut rates as expected to 4.25, so 4.25%. The vote was actually a 5-4 split, which was a little bit interesting. But generally, the feeling that we got and the feedback that we got is that, the central bank is a little bit concerned about the negative impact that the tariff regime will have on UK growth, even though the UK and US seem to be making significant progress towards a deal. The central bank feels like it needs to cut rates. That doesn't mean it's committed or it's pre-committed to a set path of rates. And I think that's, again, that just not wanting to box themselves into a corner. But the Bank of England had been more reluctant to cut rates in the last year, as maybe compared to the ECB, for example. So it does have more wiggle room to cut without risking a rise in inflation once again. But we do have data coming out this week in the UK, so we may see markets react to that a little bit. We have some jobs data, I believe, on Tuesday. So again, looking out at that unemployment rate, which is expected to tick up slightly to 4.5%. And then something that's been very important recently, of course, has been that average earnings data, which has been a key sticky area of inflation in the UK economy. I think the average earnings are expected to drop a little bit. So again, that could provide some relief to markets. And then on Thursday morning, we have the UK GDP data, that preliminary reading for the first quarter growth, actually expected to come in at 0.6%, which is higher than what we saw in the fourth quarter of 2024. So again, some pretty positive data could come out for the UK this week. So we could see maybe a little bit of a rebound in the pound against the dollar, which has been a little bit weak in the last few weeks after the dollar has attempted its rebound. And then, of course, the FTSE could try and break that barrier that we've seen just around that 8,690 level, just below that 8,700 level. We have seen a fair bit of resistance in the last few days. Again, a little bit indecision as to how much more positivity can be priced in. So that's it for the UK, really, just that key data to watch out for after the Bank of England meeting last week. From the US, Kyle, we have inflation, I believe on Tuesday, and we did see an unexpected drop in CPI last month. What are markets expecting this month?
On a month-to-month basis, a little bit of an edge higher. So there's expected that we'll see a bit of a pickup in price pressures in the economy last month. We've got the retail sales data coming through as well, which should also be interesting. Obviously, consumer sentiment has been pretty poor. There's a sense that maybe households are holding off on big purchases and things of that nature, just amidst some of the tariff uncertainty, especially now that a lot of tariffs are now in place. So we might get to see a little bit of evidence, not only of just the increase in consumer prices coming through because of tariffs, at least on a headline basis, but also in consumer activity, there might be a bit of an impact from higher prices, crimping demand a little bit. Also, just to say very quickly, in Australia as well, we've got some jobs data as well as wage price data. If that all goes to plan, it looks like we're in a rate cut from the RBA in a couple of weeks' time. Maybe we'll just quickly go to some of the questions because Danny, perhaps one to start with for you, just the pound. Interesting price action last week when the trade deal came through. There was initially a sort of a positive response that we did get this deal. It was the first cab off the rank. There was a bit of a rally, I think above 133. I'll get the chart up. Ultimately, will be driven by the US dollar story more or less, and whether investors feel confident enough in moving back into dollar assets if all of a sudden Trump and the Trump administration wants to be a sort of good custodian of the US dollar and the US dollar system. But any view there on the pound in the context of this data? Because actually, I mean, if you do look at the price action, maybe starting to round off a bit of a round off top there, arguably. Sellers sort of emerging at 134. I think the dollar's due for a bigger rally just because of positioning and sentiment. Maybe you've got an opposing view based on some of the fundamentals of the UK or the pound.
I mean, I kind of agree. It's been a very dollar heavy side or a dollar heavy trade. We know the dollar dominates a lot of these currency trades. And with the pound, even though a trade deal would be very positive for the UK economy, the pound has been rallying against the dollar, mostly on that dollar weakness, which we can clearly see on the chart here. Since the beginning of the year, it's been pretty much a dollar seller kind of story up until a few weeks ago when we've seen that positivity in the trade talks come in and try and reverse the momentum. It has been a little bit, I guess, in a way, I forgot it's been. We haven't seen that spike in the dollar just yet. We have seen some very positive trade sessions, but as you say, the sentiment does point towards the dollar strengthening further in the next few weeks if this all goes to plan, specifically with China and the US moving forward. So even though a deal with the UK, which is pretty much there almost, would be positive for the UK economy and therefore for the pound, the dollar side of the story is likely to continue to dominate in cable. So we are likely to see that resistance continue and potentially even head lower back below 132 over the coming days or weeks whenever this dollar rally may materialize, because essentially the dollar is weighing, or the weight of the dollar is likely to outweigh the positivity in the pound, given that this really does seem a dollar story right now.
Yeah, and I'm just sort of oh, sorry, I didn't mean to interject there.
Go ahead. No.
I was just going to say, like, I was reading an article in Bloomberg today just talking about how overstretched positioning was coming into the start of the year, because as we remember, there was that kind of exceptionalism story that started the year in the currency markets, that the dollar was really the only place to go because the US economy was so exceptional. We're seeing that kind of unwind of positioning driving a lot of this kind of downtrend in the greenback. It's swung the other way quite considerably. Just looking at the technicals here, though, we've got the RSI still below 50, pretty critical level. The charts to me look kind of bearish, but if we kind of push below through that sort of 101 level, maybe we start to raise the questions whether there's a greater reversion at play. Did you want to just pivot on that note as well to gold? Because I did notice this morning on the gold charts as well, just because we've got a question here as well, is that last week we had a bit of a textbook breakout from this sort of descending wedge pattern, but we failed to make I guess this is kind of debatable whether we made a higher high or not, because the price managed to close at a higher high despite not actually meeting an intraday high at 3,500 level. But it does seem that gold is ready to perhaps revert a little bit further, really on the basis that it's going to move inversely to the US dollar, obviously, but in particular equities as well, because more or less the gold trade has been the way to play negativity towards trade. If we start to see positivity towards trade, then one assumes that we'll continue to see the gold price move lower, perhaps, 3,200 could be a fairly key level there, because that is obviously what we bounced off. What was that, a week or two ago, the end of April. Structurally, I'm still really bullish on gold, but my sense is that we're due for a deeper pullback. Are you sympathetic towards that view? What do you
I
think?
agree. Yeah, I think with gold, you've got to look at it in two parts. You've got to look at the long term and you've got to look at the short term. I mean, most markets, but it's a very significant, difference right now in gold. If you're looking at that long-term momentum structurally, as you're saying, we still have that support for gold. Fundamentally, we've said this many times, but central bank buying and rates are expected to come down at some point, even though maybe not as quick as initially thought. Kind of diversifying away from the dollar in terms of the key currency and actually moving towards a gold back yuan, which is a whole different story. But there just is a lot of support for gold going forward in the long term. But if we're looking at the short term, it is very sensitive to these trade news and what's been going on. And as you said, very sensitive as well to a stronger dollar. If everything pans out like it's expected, that positivity materializes, the dollar moves higher, then one would expect gold to pull back. Now, how far it can go, because that downside does seem to be cushioned. It will be interesting. That $3,000 level for me continues to be a significant area to watch out for. Whether it's going to reach all the way down to there remains to be seen, but I think we still should continue to see some support around that 3,000 level, even if we do have that dollar momentum strengthening further. If we do dip below it, then maybe we could start to see potentially more, I wouldn't say concern, but more talks towards maybe there is more of a longer term shift in the momentum in gold. But I think short term, it does seem to be going lower, and justifiably so. But long term and structurally, as you were saying, I do still think that there is buying interest in gold for the longer term. That we also
Yeah,
have a
totally.
question on crude oil.
Yeah, I'll get to that very quickly. I just wanted to make one point of, I guess, trivia. I think there was a story I was reading today too, that the Chinese were looking at halting purchases of US Treasuries, and instead, the implication being that it would recycle its FX reserves into gold instead. So just another indicator of, again, that structural story there that is underway and has probably just been accelerated by the trade developments over the last few weeks. As you were saying, Danny, oil, a bit of a recovery here. I do love it when the technicals almost play out to perfection. We saw that big sell-off last week when OPEC announced that it would be increasing production. We spoke about it on the webinar last week. Obviously, you were on holidays for that one, but it was more or less a function of OPEC increasing production to slap on the risk. I think it was Kazakhstan and Iraq who were accused of not sticking to output quotas. But another thing that we have spoken about before in the past, and even before that, was that because OPEC had kind of thrown up its hands and said that, okay, well, we're not going to backstop the market now and try to keep it in that stable trading range of 65 to 85 or whatever it happens to be, that it's a much more demand-driven market. The marginal price action will be driven not by the changes in supply, because supply is just going to be sort of fairly loose, but the lift in the demand outlook, which is effectively a function of global trade and therefore tariffs. And so we've seen this big bounce in the last few days as the trade deals have come through in oil prices. We're now back to around $62 per barrel. This is West Texas Intermediate. I think it's pretty obvious what the key levels are, actually, Danny. $55 held nicely. 64 seems to be where the sellers defended a couple of months ago when we did get that rally. Any other points to make there on crude?
No, I mean, I think, the OPEC story is something that's been playing out for the last week or so, as you said. But of course, we also have to highlight the optimism here as well. Global growth has an impact on demand for oil, and oil is very sensitive to, as you say, to supply and demand, especially now because of these changes with OPEC. So that optimism has also been impacting crude oil. And even though, again, crude oil, specifically West Texas, is sensitive to the dollar, in this case, the dollar and oil seem to be moving hand in hand, because that positivity is driving that momentum and outstripping some of that inverse correlation between oil and the dollar. So yeah, it seems like oil is pointing higher. And if that positivity continues, if we see the statement come out with significant advances between China and the US, then it looks like the momentum could continue to go higher.
Yeah, absolutely. All right. Well, we've done 40 minutes. I think that's pretty good. Should we leave it there for another day?
Yeah, of course.
Awesome. All right. Well, thanks everyone for joining once again. It's always a pleasure to have your company. Please tell your friends and get along next week. If you have any questions, obviously put them through to us via email or otherwise. But should be an interesting week. Obviously, all eyes on global trade, and we will hopefully see you again next week.
Bye, guys. Have a good week.